Hi everyone, Brian here. Welcome back to the Cash Flow Desk. Today we're talking about something that shapes how every business handles money. Whether you bootstrap or take venture capital, the finance playbook changes completely, depending on which path you choose. We'll walk through what that looks like at each stage, the trade-offs you're making, and how your financial priorities shift along the way. Let's start with bootstrapping, building your business with your own money, revenue, and maybe some friends and family funding. When you're bootstrapped, cash flow is everything. You don't have a cushion of investor money, so every dollar coming in and going out matters immediately. This means your financial priorities are pretty straightforward. Get to profitability as fast as possible, keep burn rate low, and stretch every dollar. A bootstrapped SaaS company might focus on annual contracts upfront to improve cash flow, or an e-commerce business might keep inventory lean to avoid tying up working capital. The upside? You keep full control. Every financial decision is yours. You're not answering to investors about why you spent money on that new hire, or why growth slowed down last quarter. But the constraint is real. Growth is limited by how much cash you can generate or reinvest. Now let's look at the VC path. When you raise venture capital, the financial game changes completely. Suddenly, you have a war chest. That Series A might give you 18 to 24 months of runway, which sounds like freedom, but it comes with different pressures. VCs aren't looking for steady, profitable growth. They want exponential returns. That means your financial priorities shift from cash flow to growth metrics, customer acquisition cost, lifetime value, monthly recurring revenue growth. A VC-funded company might burn through cash for months or even years while they scale. They're optimizing for market capture, not immediate profitability. The trade-off is clear. You get fuel for faster growth, but you're also on a timeline. That runway isn't infinite, and if you don't hit the milestones investors expect, the next funding round gets harder. Plus, every financial decision now has stakeholders. Board meetings, investor updates, and explaining why you're spending money the way you are. The operational side of finance looks completely different too. Bootstrapped companies often keep finance lean. Maybe it's the founder handling books, a part-time bookkeeper, and simple tools. The focus is on accurate cash flow forecasting and expense control. VC-funded companies typically build more sophisticated finance functions earlier. They need detailed reporting for investors, complex equity management, and often more robust systems to track the metrics VCs care about. A bootstrapped business might get by with basic accounting software and monthly reviews. A VC-funded company often needs investor reporting, board decks, and detailed unit economics analysis. The compliance requirements are different too. VC-funded companies usually need audited financials, proper equity documentation, and more formal processes around everything from expense policies to revenue recognition. The risk profiles are almost opposite. Bootstrap businesses face immediate financial risk. If revenue drops or a big client leaves, there's no backup funding, but the long-term risk is lower because you're not racing against a funding timeline. VC-funded businesses have short-term financial cushion but higher long-term risk. If you don't hit growth targets, you might face a down round, get diluted heavily, or even shut down despite having a profitable business model. Here's something interesting. Many successful bootstrapped companies could have grown faster with VC money, but they also avoided the pressure that kills businesses when growth slows down. On the flip side, some VC-funded companies captured markets they never could have reached bootstrapped, but they also had to maintain unsustainable growth rates to keep investors happy. So how do you think about this choice from a finance perspective? Bootstrap makes sense if you can reach meaningful scale with organic growth, if you want to maintain control, or if your market doesn't require massive upfront investment. VC funding makes sense if you need capital to compete, if there's a winner-take-all market dynamic, or if you're comfortable with the growth expectations that come with investor money. But here's the thing. It's not always an either-or decision. Many companies start bootstrapped and raise money later, or raise a small seed round, and then focus on profitability. The key is understanding how each path changes your financial priorities and making sure you're optimizing for the right metrics at each stage. Bottom line, your funding approach shapes everything about how you handle money. Bootstrap, and you're optimizing for cash flow and profitability. Raise VC money, and you're optimizing for growth and scale. Both can work, but the financial playbook is completely different. If this was helpful, hit like and subscribe. Drop a comment with what finance topic you want to see next. Thanks for watching. I'm Brian, and I'll see you in the next one.